Saurabh Mukherjee as well joins in on the show right now. Saurabh, hi, good morning. Not really turning out to be the best of the mornings, but I'm guessing you would be cherishing this fall and buying even more. Are you?
Absolutely. I think, whilst we all want to make sure that bloodshed is minimized in Ukraine, life is far more valuable than whatever money any of us will make in the stock market. It's also a fact that Ukraine is not a central player from the global economic perspective, and neither is Ukraine going to be a central mover of global macro fundamentals or indeed India's economy. So any overreaction to this crisis in Ukraine, any overreaction, will be something we'll be watching out for. And if markets overreact, and over the next, say, 2-3 weeks, there's needless, dramatization of the Ukraine situation, we will try to make sure that we behave appropriately and help our clients profit from that. I'm not so sure we should all sort of indulge in crystal ball gazing on the oil price, because there's enough levers for the global business community to move the oil price in the opposite direction. So while this remains a crisis involving great powers, I'm not so sure from an Indian market perspective this is particularly salient for us.
Saurabh, what is it that you've been buying in this current fall?
So quality financials, as we've been saying, we got an economic recovery. And today I'm on the road with the team, meeting business people in small towns in North India. The economic recovery is gathering hold, and high quality lenders, high quality financial services companies are a straightforward way to profit from the recovery. As we've discussed before on your show over the last year or so, building materials, various types of building materials, as the building boom, as the construction boom, real estate construction boom further picks up steam. And the third area where we've been scouting for buys is the capital goods cycle, capital goods ancillaries. So we still think valuations are very reasonable. Well-run companies are available at I would still say, bargain prices. And as the economic recovery catches further traction, the post-COVID unlock leads to airports, hotels, schools filling up. We will see very tangible upward movement in earnings growth over the next 2 to 3 quarters, and we want to benefit from that.
Saurabh, good morning. Last time we interacted as well, you had spoken about building larger positions in some of the mid-cap IT stocks as well as some of the new age IPOs. What is it that you're advising at the current juncture?
So in IT services, TCS remains our largest position. We carry on building that position for obvious reasons. The order books of all the Indian IT services companies are full to the point of groaning, I think, breaking point. So with order books not a concern, we are focusing on the supply side, companies which have a steady stream of talent to hire. Supply side, talent scarcity now the big issue in Indian IT. Demand is a non-issue. So TCS in large caps and L&T Technology Services in our mid-cap rising giant portfolio. These are our main positions in IT. We also have Info Edge in our rising giants portfolio. And again, given the stellar track record of the team in Info Edge over the last 5, 10, 15, 20 years in building great franchises, we are continuing to add to our Info Edge position, which is, I know it's less IT, but way on the digitization of our country.
Right, and you'd mentioned as well that you're not losing sleep over, tracking what's going on with the movement in the bond yields, given the fact that there has been a spike owing to, of course, the global tensions and the headlines that we continuously get from overseas. Are you worried at all about the overall macroeconomic backdrop back home?
This is exactly where I think macro analysts lead investors astray. If you look at the last 70 years of data, both on the American market and on the Indian market, almost always rising bond yields, rising interest rate cycles are usually accompanied by expanding economic growth, which is what we have in America and in India. And these circumstances of rising bond yields amidst rising economic growth tend to be accompanied by strongly rising markets. So typically a U.S. rate hiking cycle is accompanied by 9 to 10 percentage point compounding on the S&P 500. And typically an Indian rate hike cycle is accompanied by anywhere between 15 to 30% compounding in the Nifty. There is no rational grounds for saying that the rate hike cycle in America or in India will lead to a bear market. And this is exactly where I think macro analysis leads investors astray, which is why I advise against the sort of crystal ball gazing that a lot of people love to indulge in.
Oh, that's right. We started reading editorial columns now, haven't we, about how usually an interest rate hike can lead to the equity markets actually go up. Mark Mobius penned one just yesterday. Good morning, Saurabh. This is Nentara also now joining into this conversation. For a lot of our viewers who will be nervous, just watching what's going on, they don't know what it is. There was a 1-hour televised address yesterday by Vladimir Putin. We've seen the reaction from the markets. Joe Biden this morning is talking about not letting Russia take profit. I wanted to lean in on your experience and talk to these viewers who are obviously nervous, seeing the kind of red that they are on their screen. Geopolitical tensions, the kind of corrections that accompany it. What kind of opportunity does it mean for retail investors? Or is this a time to just stay away? You don't have to always do something for the heck of it.
Yeah. So look, I mean, neither the opportunity nor the threat is, going to come from geopolitical tensions. Whichever way you look at it, whatever happens in Ukraine, it's neither an opportunity nor a threat to even me. The opportunity that we all have is to invest in a relatively healthy economy, Indian economy, solid macro fundamentals, more so than either China or the Western Hemisphere can offer. It's an economy low on debt, with a well-run monetary policy from the RBI. The fiscal position is on the mend courtesy the post-COVID recovery. So the opportunity in front of all of us is the same, and Ukraine doesn't change that opportunity one way or the other. In a healthy economy, invest in high-quality companies that are compounding their businesses, their cash flows at around 25%. Invest in those, stay invested, and benefit from it as your wealth grows 10x in 10 years. The more you get lost in the minutiae of Fed rate hikes, Ukraine, oil price, UP elections, the less money you will make. It will be very interesting, of course, to get lost in the minutiae, but you're not going to make any money out of it. You'll make money from the straightforward expedient of investing in well-run Indian companies in what is one of the world's healthiest large economies.
Okay, so that's advice that's coming in from Saurabh Mukherjee of Marcellus. He's seen many cycles, and this is what he would do when there's all this noise, thanks to geopolitical tensions and what the US Fed may do next month.